Thanks for checking out this video from NetPicks. And in this one, we're going to talk about two certain kind of bars that you can trade. And I'm actually a fan of both of these. So we're going to talk about the narrow range 5 and the NR7 bars. And with the NR5, we're going to look at an inside day. So an inside bar and narrow range bars. Those are examples of a volatility contraction in the market. So we can consider these as a period of consolidation. And if you drop down to lower time frame, it's a lot more obvious, but you can infer everything from these candles. So from there, when we living in a perfect world, we get volatility expansion from the coiling of price action. And this can lead to an advance or a decline in price. Now, I made a video about volatility contraction, and it's in the Bollinger Band squeeze video. But here, we're going to use pure price action to find and trade instruments that could be setting up as part of a trading strategy. So what we're going to focus on here is the 5th day, being an inside bar, and being the most narrow range bar in 5 days. And we're also going to look at the narrowest range bar in 7 days. We call those NR7s. And you can find tremendous opportunities with these setups. So first, let's talk about volatility patterns. And we all know that markets, they trend, they consolidate. So we can have high volatility, and that's important to make money. Low volatility, those environments can be pretty painful to trade. Just kind of grinding price action. And as markets move in a strong directional pattern, there are times that we're going to have price contractions as the market pauses before price eventually makes a directional move. So we look for a continuation pattern to get into the trending move of the market. Now, traders want to take advantage when volatility increases to either be in a position already or allow that strong move to get you into a trade. So in fact, depending on the chart pattern in your trade, you can almost predict which direction that signal is going to be. So if you watch this video on trading triangles, you'll learn about that. So in these price patterns, you're going to see a defined support level and a defined resistance level, right? So price needs to break out from these levels to continue the trend. These can actually be very volatile areas to trade around, so you got to have risk management on point. But the takeaway here, instead of drawing this out into a big long conversation, is that the inside day, the N5, and the standalone narrow range 7, okay, we're looking for volatility expansion from those. Now, Linda Bradford Rashke, although my take on all this is from Tony Corbell, contraction expansion principle, she would refer to this as a trend day followed by a period of contraction in the instrument. Okay, and it's not a guarantee of a successful trade at all, but it does give you an edge when it does form part of a trading plan. So the first thing we're going to do is talk about the narrow range 5. So how do we find them? You got to scan. There's scanners for these. Usually they're narrow range 4. So the first thing, you got to scan the instrument, right, for the following conditions. We want the current day's range to be the narrowest in the last 5 days. Okay, that includes that candle. The current bar or candle is also an inside bar. So it's a bar has to be completely engulfed by the previous bar, right? So here are 2 examples of what we're looking for. So each of these candlesticks, they have the smallest range out of the last 5, and they form an inside bar, okay? Let's take a look at some recent trade examples. And this is a daily stock chart of BLDP. The previous day was a completion of the NR5 as an inside bar. So just for simplicity's sake, I'm just putting on a 20-period EMA as a trend indicator, although the price action was showing you an uptrend. The trade entry on these is just the break of the high of the narrow range day. Now, there are a lot of ways a trader can use the stop loss, but in this example, to keep things consistent, to keep it easier, I'm just going to use the extreme low of the NR5 bar as the stop, okay? The profit target is going to be 1R, right? So 1 times your risk. And at 1R, traders can scale out. You can use a trailing stop or any technique that you're comfortable with. You can also use the next resistance level when you're in a long, as you have locked in profit at the 1R level. So in 1 day here, your long position is actually entered. Your target's hit 2 hours after the market opened. So there's a high probability that you do hit the 1R target on these trades in the same day. This is the ticker MAT. The target hit is in 1 day, actually 4 hours after the open. Ticker ARVL. Looks pretty good. Now it looks like all these are going to work out, right? Some are going to cause you an issue, and this is the ticker BILL. Now this trading example is not an instant winner. You got triggered in, and the price pulled right back. It's actually triggered by 13 cents. The price failed. Now your stop loss is not yet hit, right? If it's just below the low. So is this a fail? Well, we expect price to break resistance high of the inside day and begin to trend, right? But it didn't. So a trader could choose to exit by the end of the day if there's no follow through, right? Because this is a continuation pattern. Price failed to continue. So if you exit, you will take a loss, but it's going to be slightly less than a 1 hour loss. And if you look at yourself as a risk manager first, I think that should be pretty attractive. But I'll also tell you, the next day, this trade would have got stopped out for a full 1 hour if you did not get out early. The NR7 Trading Setup, right? Besides adding 2 different days and no need for an inside bar, it's very similar to NR5. This is a daily chart of ACI, and it's a good example of a valid setup that never triggers. Now, because this last candle is also larger than the previous candle, well, this chart is going to no longer qualify as a setup as it stands here right now. This is BAX. In this example, the spike was off the open, and you were in and out of this trade with profit before you could even finish your coffee. That's how fast this one happened. I'm not going to go over too many charts with this because you're not going to trade them any differently. So can you day trade them? Well, this is a 15-minute chart of GME. You can see the hit target. Now the second one, that's going to actually include the first signal candle as well, because the second one is a smaller range than that one, right? It's still 7 candles over. Now for best results, a trade management plan that allows you to take profits, to reduce your risk, and to capitalize on a move that makes new highs in an uptrend would be very good to have. Now you may also expect these to be a short-term pattern for intraday trading. Just take profits at 1 hour or maybe 1.25 hour. You could also use the opening range breakout strategy that I made in this video, in addition to trading the NR7 and NR5 inside bars. So again, I don't need to go over a bunch of charts, right? Because all time frames are going to be traded the same way in terms of your entry and your stop loss criteria. So of course, people are going to be asking, what's the best one to use? Well, there's limitations on trading the NR5 when you require an inside bar as the 5th bar. You're also going to find a lot of narrow range 7 bars, and that can lead to over trading. But one way you can increase the value of an NR7 bar is to utilize them during a pullback and a subsequent rally in price. Let me explain that. So I want you to assume that we have a corrective swing in an overall uptrend. We see the reversal and a slight pause in the advancement of price. So barring any sudden movement to the downside, right? We don't want strong momentum to the downside. This is a nested bull flag. It's a bullish chart pattern. We would expect future price direction to be up. Okay, now that nested flag, it's not always going to be this obvious, right? And it may never happen. But somewhere during these red lines, you can look for an NR7 bar. And then you just trade the NR7 bar as we talked about. This is a 5-minute chart of crude oil. It gives us our corrective decline, a reversal, NR7 bars are buy signal, trade takes off, right? The buyers step in at the lows. There is a brief slowdown in the volatility of the instrument. And we have our entry signal with the NR7. Okay, now I didn't show any examples of this. Both of these types of candlesticks are good for a bearish signal as well. Now, should you bracket order an NR5 inside bar? Now, bracket order would just be setting a buy stop above the high of the inside bar and a sell stop below. Now, we never know which way the volatility expansion is going to take place, right? So this would allow you to get into a trade in either direction. The big issue with this is whipsaw. The price heads to the downside, reverses, and rips back to the upside, and often forming an outside bar. So this 1 hour chart here, it actually triggered short, reversed. Now, one way you could play this is like this. So at one point, that big green candle was red. And once you see price regain the bar open price and turn green, you could reverse your position to long. An aggressive trader, they would reverse their position once the low of that inside bar is reclaimed and price starts to move up again. Now you have to accept that you could be entering a trade just before another small range bar forms, right? So you're going to need to decide on a circuit breaker. Well, that just means when you're going to start trading that particular chart in that time frame. Let's wrap this up. There's nothing special about these bars, okay? We're just seeing a drop in volatility over a set period of time. We then expect to see an expansion of that volatility. Now, why do I use an NR5 over an NR4? With the NR5, I'm looking at a full trading week, okay? NR4 is almost at the end of the week. I would prefer trading in the direction of the trend, right? So I'm not a bracket order kind of person. So any breakout has the potential to run. However, the odds are better in the overall trend direction. Using 1R as your profit target, it's a consistent way of using them, right? Profit targets. And you could certainly use a multiple of the average true range for your targets as well. You can use both. The stop loss should be tight. And I say that because of the context of what we're trading. We expect a breakout of the high or the low to move in the direction of the trend, right? In direction of the breakout. Any failure of price to do so, for me, is a failure of that pattern. Now, Rashki, she'll actually switch to a breakout mode the day after the NR7 forms, right? She won't counter trend trade, and she's only going to look for a trade entry in the direction the market's moving, right? She uses the bar more as information, and that would be a great time to use a breakout pullback style of trading. I think this video is a really good starting point for you to develop a trading method that uses these two patterns. Any questions, comments, put them below. Hit the like video, subscribe. Talk to you soon.